In this video, I'm going to show you how to harness the power of credit spreads, whether you have a big account or a smaller account. And I'm also going to show you for those really tiny accounts, how you can start trading credit spreads and receiving juicy premium for as little as $50. When you are selling options like cash secured puts, naked puts, covered calls, naked calls, you are selling these options. And when you sell a put, if the stock drops below the put option, you get assigned and you have to buy the shares at the strike price of the put that you sold, regardless of where the stock price is headed. The same goes for the calls that you're selling. When you sell calls, you are obligated to sell your shares to the buyer. And if the stock goes to $1,000 and you're selling a $400 call, you are obligated to sell your shares at $400 no matter where the stock goes. However, what do you do if you don't have the premium to sell puts to enter stocks to even sell the calls to begin with? If you have a $10,000 account, you can't sell puts on Meta or Google, Microsoft, Nvidia. Most of these stocks pretty much impossible to enter. And what if you have a $5,000 account? You definitely can't enter a position in any of these stocks. Well, let me show you the power of the put credit spread and the call credit spread. You can enter into these positions on great stocks to make juicy premiums with accounts as small as $1,000. And sometimes even with $500, you can get into multiple positions. You can start trading credit spreads for as little as $50. So I'm going to show you how to enter credit spreads, puts, and calls on different stocks for a regular size account, a smaller account, which is less than $25,000, and a micro account, which is less than $5,000, even as little as $500 to $1,000, because you can enter credit spread positions with as little as $50 collateral. Let me show you exactly how powerful this strategy truly is. I also want you guys to understand that credit spreads are slightly more risky than selling regular options like puts and calls. And the reason for this is when you sell a call option, you typically have the stock. It's called a covered call. Or you have a leap option and you're still selling covered calls. If you get assigned on a covered call, you can either A, exercise your long, deep in the money call option, which is a leaps option, or you can sell your shares and just let yourself get assigned if you indeed have the shares. If you're selling cash secured puts and you get assigned, well, the money's already been set aside, hence the name cash secured. They take that money, your brokerage does, and you buy the shares. So there's no real risk. When you lose one of those trades, you end up selling your shares or you end up buying shares that you already wanted anyway. Even if the stock is down, you can just hold that stock until it starts to go back up, even if it takes 6 months to a year. So it makes it fairly difficult to lose money in reality because you can just keep holding until you're in the profit. So eventually you're just trading time to go from the red to the green. So there's no real risk because the money doesn't just vanish. You get the stock or you sell your stock for money, which is good. However, when you are selling credit spreads, if you're wrong, you have to take the loss in a monetary value. And I'm going to show you exactly how to do this because you want to trade your put credit spreads a little bit safer than you would regular cash secured puts. And the same with covered calls. You want to trade them safer at a lower delta. Where the real power with credit spreads comes in is when you have a very strong confluence on the stock of where the price is likely to go. And what I mean by confluence is you have multiple indicators and assurances that the stock is going to move in the direction that you believe it will. For example, it's at a support. The 10-day is crossing over the 20-day, and they're both crossing over the 100-day, and the averages are going up, and it's becoming overbought, and the stock is rising. Then you'd have pretty good feeling and confluence to sell a put credit spread just below where the stock is moving, depending on where it was on the chart, and vice versa. If you see a stock resisting, hitting a ceiling, and it's starting to go down, and all indicators are pointing to the stock going down, then you could start selling call credit spreads above that price that the stock is currently sitting at. This way you can make more juicy premium. Let's dive right in. Let me show you guys the chart, how to time some put credit spreads and how to time some call credit spreads. And then we'll go to the options chain and I'll show you how you can execute this trade in a regular account, a small account, and a micro account. This way, no matter which account size you have, you will be able to get into these trades and make juicy premiums consistently to grow your account. So here we're looking at Tesla. Tesla is a great stock to make consistent, juicy premium every single week. I make about $5,000 to $10,000 a month selling put options on Tesla. But then again, I have 3 accounts. One has over $500,000 and the other one has over $3 million, which makes it very easy to do so. But how do you sell puts on a stock like Tesla if you have an account size that's less than $100,000? In fact, what if it's less than $50,000? You can only sell one cash secured put if your account is less than $50,000. However, how would you trade this stock by selling put options if you in fact did have an account that was that small? What if you had an account that was around $20,000 or $25,000? What if you had a micro account that was $5,000, even $1,000? Heck, even $500. I'm going to show you guys exactly what to do right now. First thing we need to do is identify big areas of interest near a resistance and a support, which is support and resistance, bottom and top, supply and demand, bottom and top. Then we got to find averages and figure out where the stock is going to move. The best way to do this is to marry your stocks. Now, I don't mean fall in love with them and hold on to them when you're losing money and allow greed to take over and lose money on trades. That's not what I'm talking about. I mean, get to know stocks that you intend on trading. This is the majority of stocks that I trade. There are some other ones like Bank of America and Ford, Wells Fargo, once in a while, Delta, Apple, American Airlines, Amazon. But this is almost everything that I trade. And I really stick to stocks I know. But when it comes down to trading every week, Netflix, Tesla, MicroStrategy, Apple, Walmart, Palantir, SoFi. That's it. I keep it to a handful, and I understand exactly where the stock is likely to go and the moves that it's likely to make. When you understand a stock and you trade it all the time, you have a very good feeling of where the stock is going to go. Sometimes you will miss and the stock will move way more than you expected it to move, or it will just move consistently every single day in the same direction, which goes against pretty much every move it's ever made in a certain time frame, which goes against your analytics or the overall knowledge that you've gained on that stock. And what I mean by this is if you are watching a stock consistently every day, every week, every month for several months, and you've realized, an example, Tesla hasn't fallen below 420 for 3 months and it hasn't been above 450, then you'd know that's the nice safe range. But there's going to be that time where the stock will drop below 420. Now, it's not going to happen all the time. If you get to know your stocks very well, this will be a very rare occurrence. And as long as you're good at managing your trade and managing your loss and cutting it quickly when you have enough confluence to understand it's going against you to get into another winning trade, then your losses won't hurt you very much at all. Let me show you exactly what I'm talking about. We can see here there's a lot of data. Forget all these lines here. They're just my put levels where I sell my naked and cash secured puts. What we're going to pay attention to right now is this black line going up, as well as this orange and blue line that are following the stock. The orange is the 10-day, the blue is the 20-day, and the black is the 100-day. These are overall price averages over a window of time or duration of time. Typically, when you see something like this on any stock where the 10-day is crossed below the 20 and they're working their way in unison together on the way down, and then they in tandem cross below the 100-day average like they've done here, you're considered to be in a downtrend. That's one confluence that we have that the stock is moving down. Now, we also have more confluence, which kind of contradicts that, the fact that the stock is oversold, meaning it's likely to return up in price, which is why we're seeing all of this selling pressure, but the stock is going nowhere. So it's hitting a support here. So how do we understand what's actually happening here? Well, what we're going to do is try to look to the left to find out in previous time, over the last couple of months, weeks, or even days, where the stock has resisted before. And what a resistance area is, or a support level, like we see right here. We go to the left and look at all this support in here. When investors are buying the stock here and sell it right here, as soon as it drops back down here again, they got out somewhere here or here and they missed profits. So they tell themselves, like we have done many times, that we're going to get back in when it gets here. So every time the stock drops to areas of interest right here, and you can see there is more right here, here, and a lot in here. So this is a very big area of interest, big time support. So the stock is bouncing off that. Do we have enough confluence that the stock is not going to go below this level? Well, right now is New Year's time. We're a couple of days from New Year's, and there's a lot of investors tax loss harvesting. So the rules don't quite apply the same way during this time. But after New Year's, maybe 2 weeks, 3 weeks into the new year, then these rules pretty much apply the same. But right now, things are a little iffy due to tax season. If you're watching this video during tax season, take that into account. If you're not watching it during tax season, then it's pretty much exactly what I'm about to tell you, which is the support, the stock moving below the 100-day, the 10 is below the 20, they're in tandem moving below the 100, and it's oversold. So there is going to be a lot of support. It's likely the stock will continue to drop somewhere down here because we have a double peak, which is another indicator. The stock comes up, comes down, comes back up, comes down, and we're going to find some support here. And usually after a double test like this, the stock will break through this support here and we'll find a previous support, which is over here and over here. So the stock is likely to fall maybe to 400 or 390, meaning a 390 is very safe on the weekly. You could sell 390s very, very safe on weekly. So let's go take a look at 390 on Tesla. We're going to go out to January 3rd, and we are going to look at the 390. We can see that 390 is 256. It's a delta of 12, which is extremely safe. So what we're going to do is we're going to go even below that to 380, which is even safer. And what we're going to do is we're going to execute a put credit spread because we can't sell the put at 375 or 380 because that would take $38,000 collateral. What if you only have a $50,000 account or a $100,000 account? You wouldn't want to have 35% of your account with just one put. So let me show you how to do this on a medium size account. Then I'll show you on a small and a micro. We're going to click on sell put, which is the bid. You click on bid on any broker, it's going to go to sell. You click on ask, it's going to be buy. So we are going to sell a 380. And what we're going to do is we are going to buy a 370. The reason why we're doing this is because we are buying the long put in order to hedge our position so that this way we are covered. If the stock drops below 370, we don't lose $38,000. The max we can lose is $1,000 because this is a $1,000 spread. You might be asking me, Corey, why would you do a $1,000 spread instead of doing a $500 spread or maybe a $300 spread? Let me show you on a chart exactly why on an account size of say $20,000, $30,000, $40,000, this isn't recommended. So here we are looking at Tesla. We're going to go to January 3rd and we're going to load up the same strike prices that we just talked about. We are going to sell one, buy the other, and these are both going to be put options. So we are going to sell the 380 put right here, and we are going to buy the 370 put. You can see this is a put credit spread, just like we talked about. $948 max loss, max profit $52. We go over to Fidelity, we can see $52 is exactly what we're going to make. Let's go back to the chart. Now look at this $1,000 spread, okay? What if we change that to a $500 spread? Let's go 375. Let me show you the difference here. We would obviously make less money. We're only going to make $29. If the stock, let's say Tesla, drops to 377.60 or 378, if the stock drops to 378, we lose $171. If we go with the $1,000 spread and Tesla drops to 378, we lose $148, $23 less of a loss. Also, break even is 379.48, whereas the $500 spread is no longer 379.48. On the $500 spread, it's no longer 379.48, it's 379.71. So when you go with a $1,000 spread, you have more of a buffer. The stock has to drop more in order to lose money, and you collect more premium up front, which is why this is happening. And if the stock does drop, you're protected because now the stock has to keep dropping further for you to lose the same amount of money. For example, on a $500 spread, if the stock was to drop to $379, you'd lose $51. On a $1,000 spread, if the stock was to drop to $379, you would lose $28. Do you see the difference? So it's a lot better. And what we can do is we can go ahead and set up a couple of these trades. If you've got a $30,000 account, $20,000 account, you could sell 3 or 4 of these. You want to keep this to 5% of your portfolio, maybe 10% at the most, but I'd say 5%. So what we're going to do here is if you have a $50,000 account, you could sell 10 of these. It's $10,000. You really want to manage this risk. So if you are 20% in the negative and it looks like Tesla just keeps falling and falling and there's no support and it keeps falling, you want to get out around 20 to 25%, wait for it to continue to drop. Once it stabilizes, then go below and sell more another week out. For example, when the stock starts moving against you, let's say you sell the 380 put credit spread and the stock starts to drop. A lot of the time you'll see this number right here where it starts getting really close to your 380 midweek, consolidates, drops a little bit below, then starts to go back up, and then it expires completely worthless. And other times it doesn't, but most times if you pick the right strike price outside of earnings or majorly bad news events, this won't happen. But when it does, and you notice it's a Tuesday or Wednesday or even a Thursday or Friday, whenever that may be, if it looks like the stock is getting real close to falling below your strike price, you can wait that out until it looks like it starts falling below even more. Then you can just get out, wait for the stock to drop, and then once you see lots of consolidation and the stock starting to move up, you can go below to another 10 to 15 delta and resell more put credit spreads to make back any losses. This is in those rare instances where you'll be in a bad situation. When I say rare, I trade put credit spreads every single week on at least 1 or 2 different stocks, and in a 3-month window, I might lose on 1 or 2 of those trades, but every other trade I'm winning on. So it doesn't really matter. So if I'm trading 2 different stocks per week over 3 months, that's 12 weeks, 12 separate times I've traded, and only once or twice I've had a problem. And I get out and maybe lose 20%, but then all my other trades are 100%. So it just doesn't really matter. I have a success rate of around 70, 80%, and my profits, my P&L is high. So in 1 week, I'll make $2,000, $3,000 in put and call credit spreads. And then if I do that for 3 straight months and I only have 1 or 2 weeks where I'm losing $1,000 or 2, then you can see how this works. It's $12,000 minus a few $1,000s in losses. So still over 3 months would be $8,000 to $10,000. It's still $3,000 a month for me. And I am trading very small amounts of credit spreads, whether it's put or call, but you can make a lot of money doing this. So you can sell about 10 of these. It's about $10,000 collateral, which is okay on a $50,000 or $60,000 account as long as you manage it. And you can get about 55 for each of these. Preview, and this is going to give you a profit of $550 a week. So you can make about $2,000 a month quite easily, only leveraging 10% of your portfolio. Now, what do you do if you have a $10,000 account and you need to get into this even cheaper? Well, what you can do is you can play this a little bit safer and you can go with a 375 put, and then you can buy the 370. This will give you about $23, maybe $24. And if you were to sell 10 of these, it would only be $5,000 collateral. $5,000 on a $20,000, $25,000 account is not that big, but you can sell a little bit less of these, go 5, and if you sell 5 of them, that's going to be even safer because this is only $2,500, and on a $20,000 account, it's less than 10% again. Very safe. And you can see here that you'll make a consistent $120 a week just selling these extremely out of the money safe put credit spreads. On a small account of say $10,000 or less, we could sell a 390 and buy a 387.50. With $250, we can trade Tesla. So right here you can see that I am going to sell the 390 and buy the 387.50. I will make $28, maybe even closer to $30 on just $250. So if we do 2 of these, we're only putting up $500 collateral, and this is going to give us about $60 on $500 collateral. This is 10% per week. But if you're asking me, Corey, what do I do on a small account? How do I generate juicy premiums on an account that has less than $1,000? Let me show you how we can do that. We're going to head over to Palantir because this is a smaller stock, and we're going to find a really good spot on Palantir. We can see a lot of support in the $78 range and a lot of support down here in 76 and even more in the 74. So we're going to do 74 or 76. So we're going to do Palantir. We're going to go out to January 3rd, of course, and we're going to do 76. We are going to sell the $76 put and buy the $75 put. This is going to give us a credit of $22 on the mid. We could probably get filled for $24. So this is $24. And let's say we do 2 of these. The collateral required for these 2 puts or put credit spreads is only going to be $200, $100 each. So on $200, we can make $50 a week just about. This is $200 a month on $200 collateral. This is double your money every single month. So if we were going to do this, let's say on a $500 account, we wanted to really grow it aggressively, what we would do is we'd go a little bit lower to the $74 put and we would sell that one. And what we would do is we would buy the 73, $100 spread times 5. And then we would try to get about 18 on this credit spread. And then we would see that our total value would be $90 a week. This is $360 a month on a $500 account. You're almost doubling your money every single month. 5 to 1,000, 1,000 to 2,000, 2,000 to 4,000. In 3 months, you could go from 500 to 4,000. I've been there, done that. I have lots of students doing that. I have students that have went from $8,000 to $40,000 in less than 5 months. Other students that have went from $30,000 to $100,000 plus in the same time frame. And then I also have students that have $300,000 accounts that went to $800,000 in 5 months. So this works, and I teach it to my students. If you're having trouble understanding anything that I'm explaining in this video, or if it seems like it's Greek to you and you want to retire or you want to make consistent profits and you're struggling, I would love to help you. It's what drives me every single day. Guys can sign up at any time. InvestWithCorey.com. Link is in the information box below. You can just click on training once you get to the website, watch the video. It'll answer any questions you may have. Then you'll be able to book a call with my team and I. This way I can help you get on track to achieve your financial goals. So we can see that this is very powerful. You can make consistent, safe premium on a stock like Palantir. But you can also trade a stock like SoFi with just $50. So if you have a $500 account and you just want to make passive, safe, consistent income on a very small account, we can go to SoFi and we could trade, and let's say set this up for a $50 spread. SoFi, I would definitely look at selling 15 because that's really safe right now. We're $14.50. Let's go with 15. We'll sell a 15. We'll buy a $14.50. And this will give us roughly $12. So for every $50 we put up, we can make $12. So let's say we want to put up $500. We could go ahead and do 10 of these. $50 each times 10, and then we will get about $12 on these credit spreads. And click preview, $120 we'll make only putting up $500 every 2 weeks. So in a month, we make $250 on 500. This is a 50% return on a small stock. But if you don't have $500, maybe you only have $300, you just lower the amount. But on a $500 account, you could sell 10 put credit spreads or 10 call credit spreads on SoFi. If you don't think SoFi is going to go up, I think it's having a little bit of trouble breaking 1650. We could sell a 1650 right here and buy a 17. And for every $50 you put up, you will make $18. Put up 100, you make 36. This means you can make $72 a month off of $100. So again, 50 to 75% return per month. And sometimes if you play a little more aggressive, like selling a 16, which I don't recommend, and buying a 1650, you can make about 24. So for every $50 you put up is 24. In 2 weeks, you do this for a month, you're doubling your money. This would legitimately be 100% return, 2x return in 1 month. This is how you grow a small account safely and efficiently. You have to understand where to enter on these stocks. For example, on SoFi, we can see a double peak. 1, 2. SoFi is unlikely to stay above 1650 or 17. So by selling 1650 and buying 17, it's very hard for the stock to go above this, and we're making consistent passive income. And this is how you do it on a small account. With just $50, you can collect $18 a week on $50. This is very good returns as long as you understand the movement of the stock, when to get in, when to get out, and how to manage your losses. This is critical. If it's starting to go against you and you're starting to see a negative and you think the stock's going to keep dropping, get out at a very small loss. Don't let the losses go exponentially against you. But worst case, you'd only be losing $50 on a $50 credit spread. And with a $100 credit spread, you could lose $100. On a $1,000 credit spread, you have to manage those even more, but it's harder for the stock to go against you in a $1,000 credit spread. One more example to show you. Let's say that we think that we're going to go look at, say, Palantir, and we don't think the stock is going to go much higher. It resisted 82.50 and it's resisted 84.80. So we think 85 or 86 is very safe. We could actually go up to 87 and go out 2 weeks or 3 weeks. So let's look at Palantir, and we're going to look at calls, and we're going to look at 87. And if we go out 2 weeks, we can see 87 is $113. We could sell this, buy the 88, which is strange. It's only giving us $15. It's because it's after hours. So what we're going to do is we're going to sell the 87 and buy the 90. So realistically, the 87 and the 88 is going to give you about the same as this, because you figure the 87 is about 115 you'll get filled for, and you can buy the 88 for probably 95. So it's about 20 to 25 on that spread. But we could do a $200 spread like this, or we can go ahead and just do the 87 and buy the 88 and probably get filled right around $20. Okay. So on a $100 spread, we make 20 bucks, which is $40 a month, 50% on average. So if we want to sell 5 of these, we're just going to put up $500 and we'll just get filled maybe even close to the midpoint. You can see on 500 bucks, we stand to make $80. So we'll make $160 a month, which is just shy of 50% return, like 35, 40%. Very safe, because we know that Palantir is highly unlikely to go to 88. If we wanted to run this strategy a little more aggressive, Palantir's had a lot of trouble breaking 84, 85. We could very easily just go ahead and sell an 84 or 85, do 84, buy an 85, we would make closer to $25 or $30. And if we sold 5 of those, then our midpoint, let's say, would be 30. We're just putting up $500 of collateral and we're able to make 150. So in a month, we're looking at 300 on 500, which is about 60%, 65%, which is really good because you're making all these trades with a $500 account or a $1,000 account. On a $1,000 account, I recommend running multiple $50 positions and multiple $100 spreads on different stocks. On a $5,000 account, the same thing, but you can run a few extra. So if you have a $1,000 account, then you can run 4 $50 spreads on one stock and 1 credit spread, whether it be call or put, on other different stocks. If you have a $5,000 account, well, then you could sell 10 $50 spreads on one stock, because it's only $500 on a $10,000 account. So you could sell 10, maybe even 15 spreads on, SoFi or SoundHound. But you have to really manage these trades, and you have to really understand that when the stock starts going against you, if you're very confident it's going to keep going against you, get out, wait for the stock to settle down, then re-enter further away from the strike price, whether that would be down or up, or just go to another stock that you're more comfortable with that is moving in the direction you expect it to, which is why I say understand your stocks, study the charts, and watch these stocks every day consistently for weeks on end to understand the likelihood and the direction and the amount these stocks move on a daily basis on average. outside of major earnings or news catalysts. This will help you greatly understanding where the risks are and how to make more money and to know where and when to get in and out of these trades. Like I said, this can be very confusing. I understand that. Credit spreads can be a little bit tricky, but I've tried to show you guys the easy way to execute call and put credit spreads and how to time it out, understanding confluence, and how to understand stock movements to make better trades. But if this still seems confusing to you, you guys can sign up for my masterclass bootcamp coaching training course and Discord at any time. investwithcorey.com. The link's in the information box below. You guys just want to click on training when you get to the website, watch the video. It'll answer all the questions you may have. Then you'll be able to book a call with my team and I. This way I can help you achieve your financial goals, just like I have for all of my other students. I look forward to speaking with you and seeing you real soon. Take care of yourselves.